Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. Welcome, traders. I'm Boyd Baker, and thanks for tuning in to my futures and options update. Today is Thursday, June 25th at about 3 p.m. And what an exciting market we have here in soybeans. Everybody's talking about the soybean complex, what's going on with the growing season this year. Let's jump right into the charts. In the past, we talked about the big downtrend taking place in soybeans. Better part of this year, we've worked down from the $12, $13 level down to a low here at $9.10 at the beginning of the month of June. Now, what's transpired here in June in the Midwest is one of the rainiest periods, and soybeans do not like wet feet. Particularly the farmers, if you have not planted, you may be losing some acreage in soybeans. You certainly could be decreasing yields if you're planting late at this time, and also the crop conditions, as good as they were, with this type of rain that we're seeing in the Midwest right now, that's explaining the big time rally that we've seen take place here in basically about the last 10 days. Now, the marketplace here today broke out of what appears to be its downtrend and is reaching up into this $10 area. Now, this is out to the public, so I want to give you a couple of ideas as to ways to possibly participate in soybeans. I'm going to give you 3 strategies. You can call me to discuss what strategy might be a best fit for you. Let's first talk about a bullish strategy. This is a vertical bull call spread. If you're still bullish soybeans, you think that we can reach higher levels in beans, one can consider, buying a call such as a 1020 call and then selling an out-of-the-money call such as a 1060 call. That's a vertical call spread. You're limited to the difference in strike prices, so that's 40 cents. That's $2,000. If you buy this call, the 1020 call for 14 cents, and you sell the 1060 call against it for 6 cents, your net outlay of cash is going to be 8 cents or $400. That's the maximum risk on this trade. It is a bullish strategy. Another strategy, if you're bearish the marketplace, if you feel that the marketplace has rallied enough here in short order and that things might dry out in July. Now, often that can be the case. When we're too wet in June, often is the case that these markets don't last, Drought markets are a little different when we get dry in July and August, but too wet in June, sometimes you get a violent price swing up, but sometimes it does not sustain itself. We'll have to wait and see. But let's say if you're thinking that prices are going to be nearing a top, one can consider a vertical bear put spread. And this is just the flip of what we talked about on the vertical bull call spread. A vertical bear put spread, you're buying a put which is at the money and then selling a further out of the money put against it. In this case, one might consider buying the 960 put here for 14 cents and then writing or selling the 920 put against it, collecting 4.5 cents. Your net outlay is going to be $475. Now, in this case, if beans were to rally a little bit more, this outlay of cash is going to be less. You might be able to put on a vertical put spread for less money if the soybean market continues to rally up. Again, you're limited to the amount that you can make. That's the difference in the strike price, which happens to be 40 cents or $2,000. Now, last scenario is a neutral option strategy. And this is where if you feel that the market is going to rally, that maybe a bottom's in place, but it's going to stall out and that it might not go much further than where it currently is. In this particular case, one can consider writing an out-of-the-money call, such as a 1040 call. These are August options. They expire July 24th. So if you're doing that, you're writing an out-of-the-money call, a 1040 call, writing an out-of-the-money put, such as the 940 put. That is trading for 8 cents. You would collect a total of 18 cents currently. Now, if volatility comes in next week with a big USDA quarterly stock report, those premiums might even get bigger. So for right now, when I'm reporting this, these premiums are trading for 18 cents. You have a dollar window, the 1040 to 940, that you're hoping that the market can stay within that window until expiration, which is going to be, again, 724. If you have any questions on these 3 strategies, by all means, call me here at 866-973-2079. We have a big quarterly stock report and acreage plannings report out next Tuesday. Call me. We'll tell you what the Linn Group is looking for. We'll put together a strategy for you in the grain complex, and I'd be happy to be of some assistance.